by Rotary Central Cayman Islands.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Caudry and I have the distinct pleasure of welcoming back Richard Maparura to the show. Good morning to you, Richard.
Morning, Simon. Thank you for having me on the show.
My pleasure, and our pleasure for all the listeners, I'm sure, as well. Richard, for the listeners, hopefully you'll remember, is a senior portfolio manager at Butterfield Bank here in the Cayman Islands. He's a recent past president of the CFA Society Cayman Islands and a periodic writer on economics and finance in our local Compass newspaper. So, Richard, welcome back. And today is a grilling for you. We are going to go into subjects of great detail in respect of finance, economics and markets. And in order to do so, we're going to start right at the very beginning, not the very beginning of time, haven't got enough for that, but what is the current state of the world as you see it, sort of from a very big picture? Because we're living in somewhat turbulent times.
We are.
There's some weird stuff going on here or there. We've got elections seemingly everywhere, which are always confusing. But let's try and sort of strip all that noise away and just, what's the state of the world as you see it?
Yeah, I think obviously that's an interesting point to start at, Simon. And obviously I want to say good morning to our viewers, and I hope this will be an interesting conversation. But my takeaway from the bigger picture is essentially, are we moving away from the recession camp into sort of like a resilient camp? I think that has been really the big topic in the sort of like the macro perspective. We have heard from IMF saying, I think the global economy has shown that it is resilient. I think those two things between the transition, either have we escaped a recession? Are we in a resilient camp? Has been very, very key in my opinion.
I guess the focus or the intent perhaps of the last couple of years of central bank policy around the world has almost been to try and bring us towards a recession, not tip us into a recession, but point us in that direction, and then do something as we're approaching the cliff to sort of smooth the path. But it seems, to your point, it seems to have somewhat failed because economic data in most places that you look at is still relatively robust, particularly in the US. You see job gains, you're seeing economic activity in various sectors doing quite well. So the chances, as one might see it, of recession in the future seem negligibly small because of all the activity that's going on.
Yes, and I think that's exactly my point, that there's been that shift in terms of thinking, right? Because when everything started just after COVID and central banks took over what they were trying to do with inflation, everybody thought they were going to push the economy globally into a recession. But the talk is, have we managed to escape that sort of like trap? And are we now in a situation where if the economy is to go globally into a recession, does it really need to be pushed in, or rather we have moved away from it just slipping by itself?
Do you think there's a risk, we'll talk about interest rates, I'm sure, and central bank policy shortly, but do you think there's a risk that central banks have maybe potentially not done enough in terms of slowing economies? So the conversation at the very beginning of this year, if you were to rewind the tape back to sort of January, the talk would have been how many interest rate cuts are going to be and how soon those interest rate cuts are going to be, because surely the economy is going to be slowing, surely the economy is going to be under pressure.
Yes.
Well, none of that seems to have happened. The economy hasn't been under pressure. The economy hasn't been slowing. So is there an argument perhaps the central banks haven't been aggressive enough in their tightening and in their slowdown attitude?
I think actually on the contrary, if you look at it, because if you look at the mandates of most of the central banks, except the US, which we might discuss separately, most of the mandates for most of the global G10 central banks is essentially just price stability. If we focus on price stability alone, you can actually see that there has been a success story there, right? Because remember, we were in double digits in terms of inflation, especially last year. And we've already started seeing, for example, I was listening to Madame Lagarde from the ECB perspective. She had a nice way of putting it. She said, at each key points, the ECB has managed to halve inflation. So they started close to 11%. They went to 5s. Now they are in the 2s. So there is a bit of a success story there by just looking at central banks and their instruments that they have and what they're trying to achieve. You can actually think that they're actually succeeding. And that's why I think now we are seeing other central banks, ECB included, and Canada as well, now starting to say, oh, it's time to start to cut rates now, because even though the objective hasn't been met, which is the 2% target, but there is convincing evidence that they are moving towards that direction. So I would give them a pat on the back and say they are probably doing what they're supposed to be doing.
Fair enough.
Yeah.
And I think, was it yesterday, Jerome Powell made the comment that he thought the labour market was basically back to the same conditions as it was before COVID ever arose.
Yes.
So I guess what that means is, before all this chaos started in the world and things went to hell and inflation took off because of supply pressures,
right,
the economy was actually doing pretty okay.
Yes.
Employment conditions were decent. And he's now saying, well, we're back to there, which was about the time when people were saying, the Fed needs to get a rein on inflation. It needs to start raising interest rates. It needs to start putting... So perhaps we're back to that sort of full employment. We can talk about why the Fed's dual mandate, but we're perhaps back to that equilibrium.
Exactly, and now you introduce the US. The US is completely different. So the problem with the Fed or the central bank in the US is that they have a dual mandate. And I think this is probably the only central bank that has a dual mandate. And by the dual mandate is obviously they focus on employment and also price stability. Everyone else, all the other central banks, they focus on price stability only. And they just use their tools on price stability, increase rates. When inflation comes down, reduce rates. But the Fed is different because they also have to balance between employment. And the problem is that employment has been below 4%, or unemployment has been below 4% now for almost over 2 years. That's the strongest it has been in many, many years. I think it goes back into the 60s. That's a challenge for the Fed, to balance between unemployment being still okay and then obviously inflation coming down a little bit. But when do we start to cut rates? Because if you do one and the other incorrectly, you misplay the other side.
So you mentioned Canada and you mentioned the EU. They've both begun the process of cutting. What was it, last week or 10 days ago or so? What do you think that means? Is that a signal for others to, hey, the time's right, now it's okay, or are our economies actually more divergent than that? And so we might see those two economies see their rates cut, but the likes of the US or the UK might be, well, let's take a little bit more time.
Yeah, no, I think that's a good question. I think again it goes back to the mandate. So the mandate between especially the US is completely different, and that's the instruction of the other central banks is they're only focusing on one line item. They're only looking at inflation. And if you look at Canada. Canada, the highest inflation was around 8%. Now they are close to 2.5%. So in their perspective, they are saying, look, we have used an instrument that has actually done what it's supposed to do. Is it time to kind of like tone it down a little bit, which kind of makes sense. But if you look at it from a US perspective, that's a completely different story. So yes, I agree. Economies are definitely different. Europe is different from the US, but obviously we want to spend more time talking about the US because it's the bigger economy in the global space.
And obviously, I suppose Cayman's interest rates are set based on what the US's are as well.
Yes, proximity.
Yeah. So let's go straight into that then. I mean, the US Fed had their meeting yesterday.
Yes.
So on the 12th of June, and they basically, from my reading of it, was they became a little bit more hawkish, I think is the expression, just in the sense of they weren't so confident that there would be as many interest rate cuts and as speedily. Well, what was your read of it then?
Yeah, no, yesterday was very interesting. So I think going into the meeting, the expectation was, or before the meeting, there was a priced in of 3 rate cuts into the 2024 year, but then they removed that. They scrapped that into only 1 rate cut. Right. But what they actually did is they moved some of the expectations in from 2024 into 2025. So they had 3 expectations in 2025, but now they made them 4. Okay. So essentially what they are doing, I think, in our sense and our reading, is they are pushing the ball a little bit further. The reason why they are doing that is they are a little bit concerned about the strength, which you mentioned, in terms of the labor market, because the labor market is still showing a little bit of some strength, and they want to delay the process of just cutting rates in case, obviously, if the labor market is strong, it means consumers might be still strong, and if consumers are strong, spending might be strong. If spending is strong, inflation might come back. So it's like a chain, right? So they need to be careful on when they can actually start to cut rates. And right now, because the economy hasn't broken in a way, they think there is no rush for them to cut rates.
And when, I guess, let's just sort of be clear on what we mean by interest rate cuts, there might be people listening to this and going, well, how big a cut are we expecting? Even though it's only one, how big a number?
Yes.
We're probably talking quite small numbers, aren't we?
Very small. So we move in quarter percentages. So it's right now we are at 5.5. If they are cutting, they are probably shedding off 0.25. So if we're talking of a cut in 2024, we're essentially moving from 5.5 to maybe 5.25. And I know it resonates more with our audience in Cayman because what they know is the prime rate. Yeah. So our prime rate right now is at 8.5. If there is a cut from the Fed in the mechanics of how this feeds in, the prime rate will move to 8.25.
Which, if we're being honest about it, I suppose is a fairly negligible change. The incremental benefit of going from 8.5 to 8.25 is still an expensive mortgage. It's still an expensive borrowing rate, isn't it?
It is.
If I listen to you correctly, we're talking potentially 4 rate cuts in 2025.
Hopefully,
I've lost track of my years already. So if we add those numbers together, that would potentially be 1.25% by the end of 2025. So then you're starting to say, actually, by the end of 2025, much more meaningful impact on people in Cayman's cost of borrowing, because you're going from 8.5 to potentially 7.25, which is a much more meaningful, much more material. 1.25% means something to everyone's spending power.
Yeah, completely. And I think, yes, and it obviously the dynamics will feed into consumers, borrowers, savers and investors, but more so for consumers. It will certainly be an added advantage. And the way consumers obviously works is you need discretionary spending. So if you have paid your mortgage, your car insurance or your car loan and whatever, those are your fixed costs. If the rates are lower there, obviously you save more for spending. And for borrowers, exactly the way you put it, the mortgages will certainly be slightly reasonably lower than where they are right now.
But probably not sufficiently low just to, it's still going to take some time. And I think one of the things that people sometimes forget is that one of the reasons, perhaps, and I'd take your interest in your view on this, one of the reasons that it's taken so long for, in the US particularly, economic conditions to slow down is that actually interest rates take so long to have an impact because of the way people fix their borrowings for a certain length of time. You might borrow for 5 years for a fixed rate on your mortgage, and then it changes. So the Fed's sort of playing a game which has 2 years before it actually has any impact in some respects, hasn't it? It
does. And I think it's mainly in the US perspective, which I think you put it correctly. So if you think about the mortgage space in the US is 30-year fixed. Mm-hmm. So people who went in during COVID, they are probably logged in like at 2.5 or 2.8%. But I would beg to differ that slightly in Cayman, because everything is referenced to the prime rate and everything is current, as you have seen. Each time there was an increase in rates, the newspapers will be flooded the next day. Yeah. So we expect also the reverse to start to happen. Yeah. Every time we get a cut, we expect the newspapers to be flooded, telling the consumers and the Cayman people that rates are coming down, and they should start to see that immediately as well, I hope. Mm-hmm. Banks will translate that immediately as well to consumers to start to reduce their mortgage payments.
Fair enough. Well, look, we're going to take a very brief break, and I'm going to come back and talk to you a little bit more about mortgages and interest rates, and then we'll talk a little bit broader as well.
Thank you.
Flow presents Flow Mania, the first ever all-in-one bundle for mobile and fixed internet.
Wow, finally!
With an absurd 1 gig broadband connection at home. For real, that fast? Insanely fast 5G for the first time ever. Are you serious? And an incredible service to keep you going. Wi-Fi backup included. What? Woohoo! Go all in. Go full mania with Flow Mania. Calculate your savings when you sign up at discoverflow.com or in store.
Water Authority Cayman wishes to advise its customers of a planned service interruption and traffic disruption in the Industrial Park area on Friday the 14th of June and Sunday the 16th of June to facilitate infrastructure maintenance in the area. These works were originally scheduled to take place last weekend, but due to the weather conditions have been rescheduled to the aforementioned dates. Traffic will be diverted from the northbound lane of Lincoln Drive to the southbound lane between the hours of 8 a.m. and 3 p.m. on Sunday the 16th of June. This maintenance requires 2 separate service interruptions. Service interruption will take place on Seymour Drive between the hours of 10 a.m. and 12 p.m. on Friday the 14th of June. a service interruption on Lincoln Drive and adjacent roads between the hours of 8 a.m. and 11 a.m. on Sunday, the 16th of June. Customers on the following roads will be affected by this service interruption: Lincoln Drive, Sparky's Drive, north of the intersection with Lincoln Drive, Sleepy Hollow Drive, Blue Lagoon Drive, Alibi Drive, Hidden Lagoon Drive, and Diane Drive. The Water Authority appreciates the patience and understanding of its customers and the motoring public as it upgrades its water infrastructure, and do apologize for any inconvenience caused.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense and our conversation with Richard Maparura, Senior Portfolio Manager at Butterfield Bank. Before the break, Richard, we had gone into some great detail on interest rates, central bank policy. And we looked at it very much from I'd call it the cost side of things. So you see interest rates go up, you see them go down, and that changes your cost of living, both positive and negative, depending on whether they're going up or down. But the other side we need to bear in mind are the investment side of the equation. So it's one thing, interest rates coming down. In the future, that will translate, hopefully, into lower mortgage costs for people.
Yeah.
But there's a flip side, which is interest rates coming down can have positive and also negative effects for people's investments that they hold, depending on whether those are bonds, equities, and the reasons that interest rates come down. Sometimes interest rates come down for good, and sometimes they come down for bad reasons, and those have different outcomes for investors. So where do you think, or what do you think the reason is that interest rates are coming down? Is it a good reason or is it a bad reason in the set? And what does that mean for investors?
I think, that's a good point. So I think let's discuss savers and then investors. Sure. So I think from a saver's perspective, if interest rates are coming down, no matter they're coming down for good reasons or bad reasons, savers are naturally going to get lesser in terms of their interest. So if you have products like your money market, they are obviously going to start to come down. Products like your fixed deposit, they will certainly come down. So if you're just a natural saver, you're going to see sort of like a downtrend as rates come down. So what would you want to do in that case? Maybe you want to lock in yourself in products that can protect you if rates are to come down. But from an investor's perspective, again, you put it correctly that if the reasons of cutting rates are bad reasons. For example, if we're going into a recession and the Fed is trying to save the US or central banks are trying to save economies, obviously that's detrimental, particularly to the equity side of the market. But if we are cutting rates because we are sequentially seeing progress and good progress and we are lending softly, right? I think that could be an impetus to both equities and fixed income. So if you think about fixed income, obviously there's an inverse relationship. So if rates are coming down, the pricing of the bonds will obviously be going up. On an equity point of view, if the rates are coming down, it might actually affect the cost of capital for doing business in general. So if the cost of capital of doing business for companies is coming down lower, that can actually help their bottom lines. So companies might actually start doing okay, even from a valuation perspective. If you do sort of like the permutations and calculations of the valuations, the discount rates will change and all that, but not bothering our audience with that, but just understanding that the two ways in which rates can be cut can be in a good way, which will be positive to both fixed income and equities, but sometimes can be negative to equities.
Let's sort of hone in just for a few more seconds on the fixed income side, because I sometimes find that it sounds somewhat counterintuitive to a lot of people, where interest rates are coming down, but that's good for potential bond investing, because it might seem, but I'm buying a bond and it was paying 5% and now I'm only earning 4%. How can that be good for me? But what you're saying, I guess what you're saying is, if you're buying it when it's still 5%, by the time interest rates go down, then your bond actual price will have gone up. So you can make money by bond investing in a declining interest rate environment by being ahead of interest rate cuts.
Yes. And I think that's where the phrase locking in comes into play. So the sooner you buy. So if you anticipate, like right now, the US hasn't started cutting. So if there's an anticipation that they will start cutting, you might want to go ahead of, things. Obviously, the market works smarter and sometimes it goes way ahead of the individuals. But the concept here is that buy in early or before the rate cut starts to come in.
So if, for instance, there were to be rate cuts in 2025, and and that actually happens,
Yes.
there's still some uncertainty about that, and you buy a 2, 3, 4, 5-year government bond right now, you're going to lock in that interest rate, even though in 12 months' time interest rates will be lower, you'll be having a higher rate of return.
Exactly.
And then your bond price will be worth more.
Yeah, which would be different from investing in like your money markets, because those would be variable. So yes, you lock in a yield and you'll be guaranteed to get that yield until the bond matures.
I think that's an important point for a lot of people who might be listening, which is over the last couple of years, there's been, in a sense, a quite easy way of making a little bit of money, which is by parking your money in a money market fund, because you can earn 4.5%, 5%, which in the context of things is not a bad return. It doesn't, if you could guarantee earning 5% every year for life, that's not so bad.
That's not so bad.
When the opposite might be, equities average 8%, something like that. So 5% with no risk, 8% with risk. Yeah, that's not a bad equation. And so perhaps a lot of people have been a little overly relaxed, perhaps, as a way of phrasing it, about, I'll just park it in money market, I won't worry about taking risk.
Yes.
But now that interest rates are forecast to be coming down, one has to disabuse oneself of that calmness, and you have to start making active decisions, don't you?
No, you're right. And I think, in all fairness, without advertising or marketing ourselves as professionals in investment space, there is an importance now that you obviously find investment advisors, because the easy money might be going away, because most clients or most customers will just park money, like you said, in the money market without even thinking, and they'll still get that 5%. But now you may want people with a little bit of more knowledge in this space to allocate your capital, so that at least you make something out of it if rate starts to come down.
And I guess the obvious question people hear, they go, okay, well, I should go and get this investment advisor. I should talk to investment professionals. Where are investment professionals such as yourself investing right now? Are you investing on a specific sectors? Are you investing in specific geographies? Do you have preferences right now in terms of where you see the better opportunities? I will ask you in due course about Nvidia, because that seems to be the only stock everyone in the world ever seems to buy. But more generally, are there areas that you think are better opportunities than others in that right now?
Yeah, no, I think I'll just briefly touch from a regional perspective. We think the US is doing much better.
Yeah.
There's a lot of capital in the US. There's a lot of innovation happening in the US. So from a regional perspective, we think the US is doing okay. Maybe to think about Japan is also a region that is also doing okay because of the mechanics that are there. And from a sector perspective, I think AI is a real story. I think it's not going away, and I guess it's part and parcel of Nvidia. But we believe that as a sector, technology is leading at the moment, and investing in that space could probably be a very good thing. You mentioned the dynamics of elections in the whole world. It's funny, actually, we have over 60 countries going to elections in 2024, and that represents over half of the population of the entire globe in terms of number, because India is involved. So India takes in like 15% already of the population.
See, if Cayman had its election this year, we could go push well over the half of the globe. It would be a dramatic change.
Yeah, add that 85,000 and 90,000. But the point is, from a regional point of view, the US is doing better. From a sector point of view, technology is doing much better. And then we have other things like commodities. Commodities have been doing very well just because of the dynamics of the setup in terms of the geopolitical risks. So if you think about the threat that there might be another war somewhere, right, things like your energy space in terms of the sector can actually do much better, because they'll be very, very much defensive if anything goes south. So I think from a regional sector, those are some of the things that we are looking at.
I want to ask you about Nvidia, in a sense, because it's such a hyped up name.
Yeah.
People who 10 years ago would never, it existed 10 years ago, it was making chips for for computers that played computer games and graphics and such like. And all of a sudden, almost everybody on this planet has heard of Nvidia.
Yeah,
they may not understand what it does, but anyone who has a brokerage account seems to have bought Nvidia.
Yeah.
Are people running away with hype, or should people be looking at that as the solution to investing in AI, or should they be taking a slightly more broader perspective in this area? Just give us your perspective on that.
No, that's a very topical question, and I will probably not have all the answers because it's too topical, but I like the way you put it. So 10 years ago, Nvidia was Apple was 50 times bigger than Nvidia. Today, they're neck to neck, right? And secondly, remember we had Nokia, and we also now have Apple. Right, we had Cisco back in the days, and there's been a lot of analogy being drawn close between Cisco and Nvidia. Long short story, from an Nvidia perspective, the interesting thing is that it's really not a hype, in my opinion. It's actually a true story, because the way we just want to look at it is you want to look at a price and the excitement in the price, but you want to base that on the earnings that the company is bringing. Nvidia has actually been bringing real earnings, and earnings has been growing. The interesting thing is that before this hype, the price earnings ratio, which is essentially the measure of how much you are paying for each of the earnings that you are getting, was in the hundreds. Now we are very much below the hundreds. Why? Because the earnings have actually grown a lot. So Nvidia has been on everyone's chat, WhatsApp, whatever, but I think for good reasons. I think this company, at least for now, it's making the money. The story is real. The earnings are there, and they are growing super fast, even more than the price. So those sort of like things happening in that space are quite positive. The company has obviously done a stock split. That doesn't really add immediate value, but psychologically, I can guarantee you, for someone who sees it at 120, they'll be buying. But they saw it at maybe 1,600. They were like, I'm not going to touch this thing. So these guys are doing a lot. They are doing buybacks as well. These are things that really adds value to the company. Threats are there. Would competition come in? Maybe, because at the moment, these guys are leads. They are the leaders, and they are providing a special type of a chip. But they are also providing to these big companies like Apple, like Meta, like Microsoft. If these companies start to decide to make their own chips, because they have the money, they have the balance.
And these chips are incredibly expensive.
They are expensive. And these guys, if they so ever decide to do that, that might be a huge threat to Nvidia. So thinking in long term, I mean, I wouldn't be overly concentrated in one name, because we have seen what has happened in the past. But I think the space in itself, in terms of AI, the story, I think, is real.
Are there other names in AI that you think people should be looking at, or should people be thinking more generally, not specific names, but just get a broader exposure to companies within that space? Yeah,
sure. So we have a company called ARM. They're in the same space. We have AMD. They're in the same space. We have Intel, even though they're struggling, they're in the same space. And those guys, they have a long history. They have capacity as well. They're building a lot of infrastructure which is needed. So there is a lot of competition within, but NVIDIA just got sort of like the head start very well.
Indeed. Well, look, I think we are almost exactly out of time. But I think we've got about 30 seconds more we can go on, I've just been told. So last piece of advice, we're entering election season around the world. We've got the chaos of uncertainty about elections. We've got the chaos of uncertainty about interest rates. Are you relaxed about what the state of markets? What's your mood? How, if I were to ask you what's your mood about where you see markets and investing, how relaxed are you about them?
Now, I think a long shot to that question, the history has shown us that elections, particularly in the US, they don't really alter the market dimension or direction most of the times. So I think that really just gives us comfort. And also our expectation, particularly from the US, is that we might get a gridlock really in the Congress. So we might have a split Congress, which might be good. Whoever will be in the White House will be literally controlled by the Congress.
Well, those are famous words to die by in about a year's time when we find the Congress has been... No, I'm kidding. But I think that's an interesting point, isn't it? Because we often over-concern ourselves about politics. And in reality, the world goes on despite what politicians' best efforts sometimes are. And businesses continue to operate. People continue to do their life. And politics is, in a sense, kind of a marginal impact on what goes on in the real world.
It is true. It's not yet 8:30 right now, Simon. Markets are not yet open. As of yesterday, S&P was at all-times high. Yeah. That should be telling.
Fair enough. Well, look, Richard, it's been an absolute pleasure having you joining us back again on Money Sense. Thank you very much for doing so.
Thank you, Simon. Thank you for having me.
And if there's civil war breaks out in the US next year, we'll have you back on and we'll replay that clip and we will absolutely see what you think about that. But look, thank you for joining us again.
Thank you, Simon. Thank you.
So as a final note before we leave, just want to remind all our listeners that this show is available as a podcast on the CFA Society Cayman Islands webpage and on YouTube. And if you have any questions or topics you wish us to cover on future shows, simply send us an email, which is to be sent to moneysense@cfacayman.ky. With that, thank you once again. Goodbye, and please do tune into Money Sense in 2 weeks' time.
Good morning. Thanks for listening to Radio Cayman. And up next will be Radio Cayman's news. But first, a time check brought to you by Foster's.
Time to start preparing for